Welcome back. Now, disinflation in Nigeria has led to the first interest rate cut for the West African nation since the COVID pandemic 5 years ago. A 50 basis point cut was made even though a number of analysts priced in a larger cut. Ridle Markus, SSA macroeconomist at Absa CIB, joins us with his reading of Nigeria's interest rate trajectory as inflation cools and what it suggests about the overall health of the economy. Ridle, thanks so much for your time this afternoon. And let's start there by discussing the rationale behind the move. First cut since the pandemic, a decision that was expected, right?
Well, yes and no. I think there were a number of surprises. We at Absa, for example, thought that they might hold out a bit longer. They have been complaining about excess liquidity for a while. So, and also inflation at 20.1% in August is still well outside the sort of single-digit target. So we thought that they will keep policy rates steady for a little longer, but there were analysts that thought that they might cut. Interestingly, I was in Nigeria just 2 weeks ago, and some of the banks that I saw expected a smaller cut of perhaps 25 basis points. I think we were all in agreement, though, that some of the other parameters were going to change, and those parameters indeed changed. For example, the cash reserve requirement was cut by around 500 basis points from 50% to 45%. And the corridor, the standing facility corridor around the MPR or the monetary policy rate, that was also adjusted. So those we are not too surprised about. But if you also read the statement, you do see that the central bank is quite concerned about excess liquidity, and hence I think some surprise at the cut that eventually came.
So then what's fueling, just from what you've said, what's fueling, I guess, then the confidence in easing monetary policy? As mentioned, inflation still in, that double-digit mark, way higher than their single-digit target.
Well, as I said, I was at the central bank just 2 weeks ago, and I did talk to the central bank, and they were fairly optimistic about the economic outlook. They were very pleased with, first of all, the disinflation coming down from higher levels, 24% plus earlier in the year to 20%. They were very pleased about the currency that not too long ago in April shot above 1,600 again against the US dollar, and now is trading at less than 1,500 to the dollar. There have been a lot of inflows into that economy, foreign portfolio inflows, and the central bank was certainly very excited about those. And hence, we saw the increase in foreign exchange reserves from around $37 billion just 2 months ago to $42.2 or $42.3 billion. So I think those, in addition to the expectation that the currency is likely to remain fairly resilient over the next couple of months, that the global fuel or global oil prices remain fairly soft, the expectation that it will remain soft. So I think there was plenty of reason for them to believe that things, especially around the cost pressures, are going in the right direction. And also keep in mind that the policy rate at 27.5% was fairly restrictive, given that inflation was at 20%. So they obviously felt that there was room for them to start cutting the policy rate. So I don't disagree with them that they cut the policy rate, but as I said, there were plenty of other concerns around the excess liquidity specifically. And to that, talking about that, they then introduced a new measure forcing banks to slap a 75% on the cash reserve ratio for public sector deposits outside the non-treasury single account.
Okay.
So they are taking some measures to address that specific issue while trying to provide relief to consumers on the other side.
Now, have we entered, or has Nigeria entered, an easing cycle? Was this just, one cut for comfort, or are we likely to see further cuts maybe in the next meeting?
I think it was the start of the easing cycle. We certainly think that there's one meeting left this year in November, that another 50 basis point cut will likely come. And then next year, I think with inflation likely to fall further during the year,
Yeah.
there's plenty of room for them to cut perhaps even up to 500 basis points over the 6 meetings that we're going to see next year. So this was definitely the start of the cycle, and I think. Um, as much as I was concerned about excess liquidity, as much as I'm concerned about the fact that inflation is still at 20%, uh, there's probably a good reason for the central bank to start providing some relief to consumers after several years of hardship for consumers, where they've seen fuel prices more than triple, diesel prices shooting up, food prices, which food inflation is still around 23%, so it's fairly high still. So consumers have been under pressure for a long time. So I think, there's probably justification in the bank's decision to start providing some relief to consumers.
So some relief coming through for consumers, and that's somewhat also going to support the economy. With that being said, just talk to me about, I guess, the collaborative efforts between monetary and fiscal policies and how that move also supports government's efforts to boost growth. I mean, President Tinubu also really adamant about getting that economy in order.
So ultimately, you want your fiscal and monetary policy to be synchronized. And I think President Tinubu has done an excellent job in appointing excellent heads of the central bank in Governor Cardoso and also Finance Minister Edun. And they understand what was required to align monetary and fiscal policy, for example. So obviously on the fiscal policy side, there was an agreement to stop budget monetization or funding the budget deficit through central bank lending. There's been various interventions made from fiscal policy side to reduce food price pressures or to increase food security. So a whole lot of efforts made on that side. While the central bank has been keeping monetary policy fairly tight, just to get inflation under control before providing some relief, so to get growth going. But we've seen that economic growth in Q2, for example, is 4.1%, on the back of efforts to, for example, to boost the oil production, which is now comfortably above 1.5 million barrels a day. So there's been a lot of efforts made on both sides. First of all, to fix some of the problems or the challenges that they were experiencing, and now starting to focus on getting the economy back on a more sustainable growth path. And it does look like, if you take into account that during the 2015 and 2023 period, the economy only grew an average of about 1%. Well, we've seen growth of over 4% last year, and this year is going to be close to 4% as well. And I think what we're going to see over the next few years is potentially growth of between 3.7 and 4.5%. So the outlook for Nigerian growth is really solid on the back of the reforms that have been done under the Tinubu administration.
All right, let's leave it there. Ridle, thanks so much for your time and just taking us through everything taking place in Nigeria and how that is filtering through to the economy. Now, that was Ridle Markus, SSA macroeconomist at Absa CIB.